Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past, but also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty Index was down 0.3% for the month ended May 2024. The Nifty Midcap 150 Index was up by 2.2%, whereas Nifty Smallcap 250 Index was down by -1.3% in May 2024. Global indices ended the month of May 2024 on a positive note. Dow Jones and Nasdaq were up by 2.3% and 6.9% respectively, and Financial Times Stock Exchange 100 was up by 1.6%. The India VIX saw a steep increase in May 2024. It was at 24.60 compared to 12.87 in the previous month, up by 91.2%. The Chicago Board Options Exchange VIX saw a decline in the month of May 2024 and was at 12.92 as against 15.65 on the previous month, down by 17.4%. Sector-wise, Nifty Metal 6.0%, Nifty PSE 5.2% and Nifty Realty 4.7% were the top-performing indices, whereas Nifty PSU Bank -2.9%, Nifty IT -2.5%, and Nifty Private Bank -1.3% were the laggards. Foreign institutional investor FII were net sellers for the month of May 2024. Net FII outflows were rupees 27,437 crores. Domestic institutional investor bought stocks worth rupees 55,133 crores, whereas mutual funds were net buyers worth rupees 45,166 crores. Nifty PE is now trading greater than one standard deviation above the mean PE, however, it is still 12.5% below its peak. Nifty Midcap 100 PE is trading greater than one standard deviation above the mean PE, however, it is still 5.0% below its peak. The Ukraine-Russia war, China-US trade standoff and the Red Sea crisis have rocked India's exports. The domestic economy, however, has improved, with FY24 domestic GDP, excluding exports, having grown by 9.5%, significantly higher than the previous year's growth of 5.1%. Gross fixed capital formation that represents domestic investments has emerged as the key driver of growth. Also, on the supply side, manufacturing and construction have witnessed a strong growth momentum. Capex by private corporations increased in FY23 to rupees 29.5 trillion, a 20% year-on-year increase from the previous year. We expect infrastructure investments to continue given the government's intent to improve public infrastructure. In FY25, the central government budget allotted rupees 11.1 trillion towards Capex, a 17% year-on-year increase. Private sector is seeing an upward momentum in new investment project announcements. Also, completion of investment projects by private sector has improved in the last 2 quarters of FY24. However, the sector still lags the government sector. Within the key sectors, manufacturing sector has gained share in new investment project announcements over the last 4 quarters. India's corporate profits as percentage of GDP is 4.9%, which is lower than the high, reached in 2007 of 6.9%. We expect corporate profits and profitability to continue to increase. Mid-cap and small-cap profitability is significantly lower than large caps and its peak level in FY 2007. We believe that the conditions are right for profitability to continue rising. Indian markets ended on a mixed note, with mid-caps outperforming large caps and small caps. Industrials, metals, capital goods, central public sector, enterprises and public sector banks were outperformers, while private banks were underperformers. Valuations have reached at the higher end of the band currently, but is not very different when the recovery trade started from FY 2003 onwards. What we can also observe is that valuations may remain at elevated levels for a higher period of time, as in the previous cycle between 2006-2008. Also, G-Sec rates generally moved upwards as the cycle continued for a longer duration, indicating that inflation and a general tightness of money pushed interest rates. Inflation rates started low in 2003 at below 4% before peaking at nearly 12% in 2010. Will this repeat again? Only time will tell.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.